Okay, solution to the fourth of the Module 7 additional problems. This is going to be a downstream sale. Big is selling equipment to Little for $48,000. The equipment had been purchased by Big for $100,000 a few years earlier and was being depreciated straight line over a 10-year expected life with no salvage value. Both Big and Little use separate accumulated depreciation accounts, and they're both going to use straight line depreciation. The expected total life and salvage value are unchanged, and let's go ahead and for this one, let's assume that Big uses the partial equity method. First order of business is to determine the book value at the time of sale, and then from that we can get the gain or loss and go forward from there. So the cost of the asset was $100,000. It was being depreciated straight line over 10 years, so $10,000 per year, and had been depreciated for 2012, 13, 14, 15, 16, and 17. So 6 years of accumulated depreciation for a book value of 40. It was sold for 48, an $8,000 gain. And again, that $8,000 gain is going to be recognized over the remaining 4 years of the asset's life at the rate of $2,000 per year. Okay, so let's go ahead and do our elimination entries for 2018. What do we need to do? Well, first and foremost, we've got to get rid of that gain. So we'll get rid of the gain on sale of $8,000. That's easy enough. Next, we need to make it appear as though this sale never happened. Now, when this asset was sold, Big company or Little company, the accumulated depreciation of $60,000 was removed. Basically, we need to restore that accumulated depreciation. So we'll put that accumulated depreciation back on the balance sheet, because again, it would have been removed when the asset was sold. In terms of the asset itself, it's now on Little's books at $48,000. The true cost is $100,000. So we need to go ahead and write that back up to its correct value of $100,000. So again, it's on the books at 48. We're going to add 52. That'll take it up to $100,000. And very conveniently, this entry balances nice and neat. Now the question becomes, do we need to recognize some of the gain this year? So again, we look at the date of sale. We say, look, this equipment was sold from Big to Little on January 1st. That means that during 2018, Little recorded depreciation expense based on their cost of $48,000. Again, Little is reporting depreciation expense, cost of $48,000, spread over the 4-year remaining useful life of $12,000 per year. That's $2,000 too high. So we're going to go ahead and undo $2,000 of depreciation expense. Like so. The income to the non-controlling interest, they're going to get 40% of their share of the subsidiary's adjusted/realized earnings. Now, this was a downstream transaction. That means that the non-controlling interest is not affected by this, and so the non-controlling interest simply gets their share of the reported earnings. And it's important. When there are assignments that say calculate the income to the non-controlling interest, even if it's a downstream transaction, you still have to go through the transaction and show what that number was. If you simply leave it blank, I don't know if you're leaving it blank because you forgot to do it, or because you don't know how to do it, or because you know that the non-controlling interest isn't affected by this. You've got to do the calculation and show it. Okay, 2019. We need to carry forward the remaining unrealized gain. Again, there was an $8,000 unrealized gain last year. We recognized $2,000 of it, so there's $6,000 being carried forward. This was a downstream transaction, so the entire $6,000 is going to accrue to the parent. And since we're using the partial equity method, we have to adjust retained earnings. Again, I go into some length on this in another presentation. Basically, the idea is that under the partial equity method, Big company, the parent, they did not adjust or correct their investment income to remove the unrealized gain or loss. So their income was overstated back in 2018, which means their retained earnings is overstated, which means we need to fix the retained earnings by reducing it. As far as the rest of this is concerned, let's go ahead and see how these balance sheet accounts carry forward. The equipment, we debited it for 52, didn't do anything else to the equipment account, so we're going to go ahead and debit the equipment for 52,000. The accumulated depreciation, again, look at what we did. We have a $60,000 credit, a $2,000 debit, so we're carrying forward a $58,000 net credit. And we repeat our depreciation adjustment. So I'm just going to copy and paste that because I'm lazy. Okay, finally in 2020 we do the exact same thing again. And again, I'm going to go ahead and copy and paste. Again, copying and paste, nothing wrong with copying and pasting, especially because it sort of reinforces the idea that this is just a recurring pattern. Initially in 2018 there was an $8,000 unrealized gain. We realized or recognized 2,000 of it, so we carried forward 6. Carried forward $6,000, recognized 2. Now we're carrying forward 4. Accumulated the equipment account, again, we debited the equipment for 52, didn't make any other changes. Finally, the accumulated depreciation, in 2019 we credited it for 58, debited it for 2, so we're carrying forward 56. And we adjust the depreciation expense for the third and final time. Now, quite honestly, this asset had a 4-year life remaining. We've done 3 out of the 4 years, so let's go ahead and be wild and crazy and go ahead and do this for 2021 as well. So 2021, we're carrying forward the last $2,000 of that previously unrecognized gain. Accumulated depreciation in 2020, we credited for 56, debited for 2, so we're carrying forward 54. And then we recognize the last of that $8,000 gain. Again, we took away $8,000 in 2018, and we gave it back 2,000, 2,000, 2,000, and 2,000. Now finally, let's assume that at the end of 2021 the asset is fully depreciated. It's got a 0 book value on Little's firm, and if Big had kept it, it would also have a 0 value. The only problem is if Big had kept it, it would be listed at cost 100,000 less accumulated depreciation 100,000 equals 0. Instead, it's on Little's books as cost 48,000 less accumulated depreciation 48,000, book value 0. So even though this asset is fully depreciated, if it's still continuing in service, we still need to clean up the balance sheet. And again, let's look at how these things carry forward. Last year we had a $2,000 unrealized gain we carried forward, and we recognized the last of it. So there's no more unrealized gain to recognize. The equipment account, we still have to correct that to get it down to its correct level. To get it up to its correct level. Again, it's on Little's books at 48, needs to be on the books at 100. Same thing with accumulated depreciation. Last year we credited for 54, debited for 2, so we're carrying forward $52,000. We're adjusting the accumulated depreciation on the balance sheet from Little's reported value of 48 up to the correct value of 52. Okay.